Welcome to the final series today. I'm Joseph Novichko, Senior Trading Manager with GDM. Today's session, ladies and gentlemen, we will have a look at market momentum. But before we actually get into the action itself, I would like to stress on some recent events that we've witnessed all together, and that was the historical event of Federal Reserve interest rate hike with 25 basis points to 0.5%, with a range of 0.25 to 0.5 for the following year. Of course, as expected, the unexpected fact would have been if the policy was unchanged. However, the Federal Reserve did not disappoint traders and investors who were actually pricing in the market for the particular event. No major movements on the market were spotted at that time. It was quite an expected event from the Federal Reserve, so the markets were widely priced in already for this particular hike. However, what we also saw was the prediction that we've made last week, and that was mostly about the investor sentiment and what an eventual rate hike would lean to, which side and which direction of the market of the investor sentiment. So we saw a bit of a strengthening to the dollar. Obviously, everything against it was falling down, with a very simple exception, a minor downside direction on the euro, upside for the yen. That is mostly because of the yesterday's event of the Bank of Japan that actually disappointed the markets, because widely investors and traders around the world were expecting larger stimulus, and most of all a stimulus that could have happened last night. But it actually happened the same when we saw Mr. Mario Draghi delivering his speech on the markets, and it happened the same with the yen. Actually, it picked momentum, started going up against the dollar, weakening the greenback itself, and causing other currencies to retrace from their recent decline, such as the British pound, the euro, commodities like gold. Oil, however, on the other hand, is strictly focused on supply and demand, so the stronger or weaker dollar does not really mean much for oil prices. So it is the fixed supply and demand at the time that actually causes the price to go lower or go higher. As expected, gold turned negative on the yesterday's session with about $15 downside movement, which was also predicted from my department, as most of our traders are receiving our recommendations on a daily basis. They saw the recommendation in the afternoon of the European session. That was at the opening of the US session, which of course gave an opportunity of a beautiful profit between 1,000 to 1,500 US dollars per lot on yesterday's move. And the expectations for gold prices are to head towards $1,000 an ounce, as to the particularly stronger dollar and the DIC itself. However, I'm not going to stress too much on this event, as it's already in the history books, and what we can expect from now on is, per prediction of our sentiment and the investor sentiment, according to all of this, we have given a bit of a prolonged recommendation, and most of all an outlook of future price change of major currencies towards the next 2 years, 2016 and 2017. For those that were not here at that time, we might be able to assist you further on receiving these particular outlooks by just just make a request on our support department in the chat on our website gdmfx.com, or directly on our hotline, or directly at our emails to your particular account manager, or to me directly, depending on who you're actually trading with at the moment. So you can get in touch directly, and I can me or someone else from my department who is in charge of your trading accounts will be able to assist you with these particular outlooks from the firm. But my focus today is on the momentum market, because once we have a bit of a certainty, a bit of a bit more calm waters, and we have already ruled out any particular unfavorable events that might cause any losses to our accounts, such as the uncertainty of a rate hike or not, or any kind of a stimulus from ECB or BOJ. Anything of this matter, we already know how it's actually going to be for the 2016. So by our account, by our expertise, we believe that the second strategy that could be very useful to you, and is a bit more conservative strategy than the one that we actually saw the last time this week on Wednesday, is the momentum trading. Now, we've stressed a couple of times, I have not really presented too many times this particular strategy as of a live webinar, but of course the recordings are there, and if you need to refresh your memory, you can always request the link directly to the video, or you can just wait a few days to receive today's session uploaded into our channel, so you can see it one more time if you've missed something. But the information that I will stress on today will be rather on commodities, instead of talking about currencies as we usually do. So as the less risky type of instrument to be traded nowadays, there are quite a few actually from the majors. One of it is the cable, the other one is gold. As the uncertainty of rate change is already in the past. Now, what is left from now on is technical trading. So we already have one strategy that is performing particularly well, making us quite good profits on a daily basis. Now we need to have something more conservative, something for those traders that have limited time to turn their attention on the market. Most of all, they have their daily jobs, they're not full-time traders, so they need something on a side to invest on, to reassure, to have something more in addition to their paycheck at the end of the month. The simplicity, but the efficiency of the trading strategy that can actually make you about 200 or more pips on a weekly basis is extremely easy. It combines elements of market profile with price action setup. Now, it is a trend following type of strategy that identifies a clear direction of a specific pair or a commodity, and a strong momentum that ties to capitalize using price action setups that are in line with the momentum itself. The particular strategy works extremely well on very liquid and volatile pairs like the euro dollar, the British pound versus the US dollar, the euro versus the JPY, GBP JPY, Aussie dollar, USD Swiss franc, euro Swiss franc, gold, if you wish, USD JPY as well on some matters, and the Euro GBP, also the USD Canadian dollar. But these final three currency pairs have particularly lower volatility as of an average base. So I don't really prefer to trade these currency pairs with that particular strategy. However, you will see later on this session why volatility is important. So, getting straight to the details of the trading system, we will use a weekly candlestick chart to identify direction and momentum of the price. We will of course then use the 4-hour chart candlestick to identify trading setup, and also the 15-minute chart to help us enter the trade with a stop loss and take profit levels as well. However, for take profit and stop loss levels, you can also use a major support and resistance levels that are visible on 1-hour and 4-hour charts. Also, you can use the 30-minute chart as well. It really depends on what type of profit you're looking at, and according to that particular profit, you will set up your stop loss as well. The most important component of the trading system is this. And of course, it's derived from the market profile technique. It is basically a different charting technique that can help a type of trader to better identify at what level price has been traded the most in a given time period, and to establish a value area for a particular pair or commodity which is considered to be the range where over 70% of all trades in the specific time period has taken place. This value area, however, acts as a very strong support and resistance area. We will, of course, take a look at exactly what I mean. Another concept of market profile, of course, is called the initial trading range, which is the very first hour of trading of any given day. This is the staple of the market profile chart, and of course, all those other components of it derives in one way or another for the initial trading range. And it is obvious that the initial trading range is what we're interested in. So to get straight to the point, after some time of relying on this type of strategy on live accounts, I've came to the conclusion that the initial trading range in the financial markets in any charting technique is the first 16 hours of the trading week. The boundaries of these 16 hours act very strong as support and resistance zones. So let's have a look at the chart we have in hand to better identify what I'm trying to tell you. And most of all, this particularly weekly chart here, let me just get rid of the scroll here. Now, as you can see, strong bearish or bullish candles on the weekly chart, one more time, is what we're interested in. But most of all, the type of charts, the type of the let's say the type of candlesticks that we're interested in are those with little or no shadows on the upper and lower boundaries, such as these, or these, or we have these here as well, and also this one here, which is quite close to present day, so I'm actually going to take this one as an example. Now, what we've talked about the momentum earlier, and I mentioned that we will use the weekly chart to see if there is a momentum in a given, let's say, instrument, commodity or a pair. It really matters little. That means that we will look for a strong directional weekly candle with small shadow or no shadow at all, and a close at or near the high or low. So as I mentioned here, we will take this particular candle as an example because it's the one that actually formed last. Now this was 1st of November 2015, and we can see that this particular candlestick pointed out have very small shadow and with a close near or at the highest or lowest point of that particular range. If there is a strong bullish candle or a strong bearish candle, we want that particular candle to close as close as possible to its lowest range or its lowest extremum or the shadow that is actually formed. When such a weekly candle forms, there is a good chance that in the following week prices will trade in a small range for a short period of time and take off again in the direction of our large bearish candle. The same reasoning, of course, is valid for a strong bullish candle, which it's pointless to point out because it's vice versa. Everything works the same. As we mentioned earlier, we're going to use the 4-hour chart to find price action setup after we have identified the direction and the momentum on the weekly chart. So we're going exactly at the 4-hour chart. Let's find, there is the particular event where it appeared. Now this is the week that we've actually taken as a range. Now this particular weekly candlestick has closed over here at that time, okay? But during that time it has formed a long bearish candle. Let me get the pen here so we can start drawing. So from the opening to the closing, we have a range of certain pip size. The extremums are between here and here, and between here and here. So we can see that the closing is at or very close to the extremum, which is what we're interested in. We're not really interested in the upper shadow that much, rather than we're interested in the shadow below, because that particular shadow will give us the potential for the next week's move. And as we can see, it's a sharp move down. With how many pips, we will find that out. Now, as we mentioned, the initial trading range is the first 16 hours of the trading day or the trading week. So as we know that the period separators are giving us exactly 1 week when we're looking at a 4-hour chart. If we're looking at a weekly chart, we're looking at a 1 year period separators. If we're looking at a daily chart, we're looking at a 1 month period separators, and so on. If you're looking at a 30-minute chart, 4-hour chart, 15, 1 hour, 5 minutes, 30 minutes. As you can see, it is very easy to understand how the period separators work, and it's what we need. So what we need is the first 4-hour candlestick that marks the first 16 hours of the trading week. That's pretty much the first trading day, as we also are able to put. Now let's bring it up closer so you can better see the first 4 candlesticks. 1, 2, 3, 4. As we can see, the highest point with the extremums, one highest point is over here on the 3rd candle, and the lowest point is here on the 1st candle. So that makes about 90 pips of range, which is the range that we need to see. A smaller range below 70 pips, let's say, would be a range considered too tight to trade with this particular strategy. And as you can see, the upper and lower boundaries are acting as strong support and resistance area. But once broken, a large volume candles are going to occur with a potential of about 443 pips of profit on a weekly basis. Now, no matter the account size, but let's say you have an account that can sustain a trading risk with one lot. This is $4,430 of profit for 1 week with only one lot. And to trade one lot, you need at least something close to $10,000 account to get as close as possible to that aggressive type of trader, which is 10% out of your account, which is 10,000 and 1,000. Now, how about that you're able to double your account in 2 weeks? Wouldn't that be a trading strategy that you're going to use? Now, I would definitely use that. Of course, it's a conservative type of strategy because it focuses on larger time frames, the momentum that you need to wait for. So you are either going to get 1 trade per month, or you're going to get 2 trades maximum per month. Because if you're getting 2 trades, you can't really get 3 trades per month, unless, of course, you separate your take profits on certain levels. Now, I would definitely enter with an amount and add to it every time I see a high, such as this one, with additional lot to double or even triple my profits on a certain base. Your take profit levels are extremely easy to find. Now, in this example, the best way to find our take profits, obviously our stop loss, would be on the previous extremum, which is here, previous week's last extremum on the previous week, which is over here. A few pips higher, we'll bring it somewhere over here, which is perfectly for a stop loss. Of course, as from your initial entry, that makes it about 200 pips of stop loss and 400 pips of profit, which makes it perfect 2-to-1 risk-reward ratio, sustainable by any trading plan and any trading system. So that drives us to find our take profit levels appropriately. We have to go out, to zoom out a little bit and see precisely on our previous trading levels where exactly the price had difficulty to break through. One of it is here, but it's very close to our initial opening. So the next support level is around those candlesticks. As you can see, there are a lot of here. It's a lot of choppy trading. So I definitely would put my first take profit over here, as well as we can see that the consolidation between the 2 candlesticks over here is precisely at this particular level. Or you can either enter with another lot if you're more of an aggressive type of trader. I will take half of the profit here. The second half will come somewhere around this level or this level in particular. And the rest of the account I will leave for a larger time frame, a larger take profit, such as a consolidation somewhere around these groups here of these candlesticks. So as I can see, the appropriate level will be somewhere around here. So if you're more of a conservative trader, that's about 95 to 100 pips of profit, which you can actually cut short. Basically take only 300 pips of profit if you want to be sure, because this group of candlesticks could act as a very, very strong support area. So the strong momentum, however, in this case, breaks through all of the group in one time, in one candle. But what if the next time it does not happen that way? So the majority of times the price will actually stop somewhere here and then reverse to its initial entry point. In very few cases we will have a breakthrough with a very strong candlestick, and the price might tend to continue. But this particular word might, could, or should tends to lose a lot of money. So being on the safe side of the market, you better take 300 pips of profit instead of taking only just 100 if the price reverses too aggressively, or go down to a zero on your running profit and your whole week of trading is ruined, or if you wait too long, you might even end up with a loss. That means that you only trade for the first week and you do not trade further on, no matter what happens. So bringing the chart for close to sorry, I had to scroll up and down a little bit more. There we go. So the first week ends with the last few candles here. As you can see, the group of these small undecided dojis, which means that whatever happened here, it already happened. You had a very, very strong candle. Your take profit hits somewhere over here. You have no idea whether it's going to continue another 100 pips. Maybe it's going to go another 200. You have no idea. But at least your profit is certain at that point of time. So the week is ended. You have already taken your profit on the previous day, because this is 1, 2, 3 candlesticks. That's 16 hours. That means this is Friday, and this is somewhere around Thursday afternoon, European session. That is where you're taking your profit, and you've already collected comfortably around 360 pips of profit. That's it, $3,600 on a $1 traded, on one lot traded. So that is a profit I would be very likely to see, and I will appreciate to see on your accounts, dear traders. And do not speculate with what if should have happened, what could have happened. This is something that will get you to back to square one, you know, to the psychology of trading. So you have to manage your emotions to a level where only systematic trading will account for your actions. So whatever happens, you already made about as close as possible to $4,000. That's almost half of your account for 1 week. So wait for the next week. It's not the only currency pair or the only commodity that you have. Now, if you're trading on such events and you're looking for momentum to trade, you can always open 2, 3, 4 charts, maybe even more charts if you have more than one monitor at your disposal. You can monitor many currency pairs and commodities at one time, place multiple trades if your account balance and your risk management system allows it, which of course can expand your profits exponentially without a problem whatsoever. But do not mistake to think that this can occur every week or every month. That is why this is a more of a conservative type of strategy with a success ratio over 90%. Because when we have a strong momentum, not a sideways direction like this one, which is obvious, we do not trade it. We have larger than 90% certainty that the price movement will continue the same direction as the previous week. More certainty than that you can never get. Trust me on this. Now, the one thing which is very important here to set into your trading accounts, and most of all on your trading systems like this one, is the 200 exponential moving average, based on the fact that when we have the price at or close to this 200 exponential, we do not trade. As you can see, even if we have a good direction here, we have a momentum that has crossed the 200, and we better not trade it, because as you can see how quickly the price can reverse. So this is one of those that can actually stop you from taking any trade in a particular time because of the moving average, which is extremely important, and that's the 200 exponential. So these examples that I just gave are extremely valuable, especially for traders that have very little time to take a look at the market. But let's say you're working on your daily job, you're at your office or a construction site, or if you wish on an oil rig, if you're working on an oil rig. In any case, you always have the time to have a look at the chart at least once a week, and that would be on Friday. So when you see that the closing of the market is with a high momentum, very large candle, you are going to look on the next week, on Monday and Tuesday, for a price action setup on the 4-hour chart to place a good trade and profit from it while you're working something else, because you have more than 90% certainty that the direction will be the same as the previous. If all the rules and the setup of the chart has been met, the trade is there for your grasp to take it. That's all about the strategy. I'm not going to keep you too much away from your trading, because technical trading prevails from now on, especially throughout 2016. If there is something major that comes on the market, we always inform you the same day. Thank you very much for being with us on this last webinar for this month. Please be advised that for the next 2 weeks I will take a vacation throughout Christmas and New Year. However, I will be at disposal to most of you that you are, to those that are trading with me, have my direct contacts, have my extension to the office number. It will be possible to get in touch with me if there is something very extreme. I live very close to my office, so it's about 20-30 minutes traveling with my car. If there is something that I can help you with over the phone while I'm just baking cookies for Christmas, I will be able to do so. Please do not hesitate if there is something that you need to receive. The company is here to help you trade. Thank you very much for joining us. I'll see you next year. Bye-bye.